Now picture this moment very clearly. Just yesterday, chaos, panic, headlines screaming about a Bitcoin crash, red candles slicing through the chart like knives. $60,000 was briefly lost. Social media exploded. Fear and greed flipped sharply to the downside. These are the exact moments when the market decides who stays and who gets left behind forever. Because while you're panicking, while stop losses are getting triggered and retail reacts emotionally, something completely different is happening in the background. Bitcoin is now back above $71,000. Not slowly, not hesitantly, but aggressively reclaimed within just a few hours. And the real question isn't whether the market looks strong. The real question is, who bought this dip and why right here? Because on-chain data tells a story you will never see on a regular price chart. While price was falling towards $60,000, data from Glassnode and Arkham Intelligence shows massive supply absorption. Large wallets, so-called whale addresses, did not sell in this zone. They bought, not emotionally, not impulsively, but systematically, piece by piece, exactly where panic peaked. This is not a new pattern. This is an ancient market game. In 2017, after the brutal China FUD, we saw the exact same structure. In 2020, during the COVID crash, it was even more extreme. Price collapsed, fear was everywhere, and at the exact moment everything felt hopeless, long-term players began accumulating. Not because they were trying to perfectly time the bottom, but because they understood how liquidity really works. Markets don't fall because of bad news. They fall because liquidity is needed, and liquidity is created where fear exists. That's exactly what happened yesterday. Below $65,000 sat massive stop orders. Below $62,000 were leveraged long liquidations. And around $60,000, the perfect liquidity cluster had formed. Price moved there like a magnet, not randomly, deliberately. And while retail was selling, while emotions took over, institutional players stepped in. Spot ETF data shows strong net inflows. BlackRock doesn't buy because an influencer turns bullish. BlackRock buys weakness. BlackRock buys when the market goes quiet, when no one is talking. And here's the part many people completely underestimate. These ETF inflows are not paper Bitcoin. These are real coins being taken off the market. Coins no longer sitting on exchanges. Coins not immediately resold. Every single BTC absorbed by these products reduces available supply. At the same time, on-chain supply data shows that Bitcoin held on exchanges continues to decline. Long-term holders are not moving their coins. In fact, the percentage of supply that hasn't moved in over a year remains extremely high. That means one thing: supply is dry. And a dry market reacts violently to demand, like a beach ball pushed underwater. The longer the pressure builds, the more explosive the move when it's released. Now look at the current price structure. Bitcoin is holding the $71,000 area as support. That's not a random level. This zone previously acted as resistance. Old highs turning into new support, classic bullish market behavior. Above us now sits the $74,000 region. And this is where things get interesting, because that's where the shorts are. A lot of shorts. The derivatives market shows rising open interest, while funding rates remain relatively neutral. That means positions are building without market euphoria. And that is extremely important, because explosive moves don't come from euphoria. They come from imbalance. If this $74,000 area breaks cleanly, we're not talking about a slow grind higher. We're talking about a short squeeze. Liquidations falling like dominoes. Positions being forcibly closed. That's how fast moves towards $78,000 or even $80,000 are created. Not because Bitcoin always goes up, but because the market structure mechanically forces it. Now let's zoom out. Because this moment doesn't exist in a vacuum. On the macro side, very little has changed. Inflation is still structurally present. Governments continue to print. Debt continues to rise. Trust in fiat erodes slowly, but consistently. Companies and even states are no longer viewing Bitcoin as speculation, but as strategic insurance. Samson Mow has been openly talking about a coming supply shock, not overnight, but gradually, quietly, while no one is paying attention. And don't forget, after the halving, miners' daily sell pressure was cut in half. At the same time, demand sources are expanding. ETFs, institutional products, family offices, in some cases even state-level actors. This is a structural shift. When you look at previous cycles, the pattern becomes clear. After the halving comes volatility, pullbacks, doubt. That's exactly the phase we're in now. In 2017, this uncertainty lasted for months. In 2020, the same thing happened. But every single time, it became the foundation for the next major impulse. Psychologically, this is a masterpiece by the market. Yesterday was fear. Today is uncertainty. Tomorrow could be FOMO. And this emotional roller coaster is exactly why the majority always acts too late. The market is playing a game you don't see. It's testing how many people are willing to give up their coins. And every time panic appears, those coins move into stronger hands. I'm not saying price only goes up from here. Volatility remains. Pullbacks are always possible. But the structure, the data, the on-chain signals are speaking clearly. We are at a critical point. A point where small impulses can trigger massive reactions. Once you see that, you stop reacting to candles. You start understanding why they exist. Let me know in the comments how you're interpreting this phase. Was this the shakeout the market needed? Or do you think one final trap is still ahead? Debate it with the community, because that's where the best perspectives are formed. And if this kind of deep market insight helps you, drop a like, not for the algorithm but as a signal that you're willing to look deeper than most. Because while others react to headlines, you're learning to read the language of the data. And that's the difference between participating in the market and truly understanding it. The market is at a turning point. The question isn't whether something will happen. The question is simply, will you recognize it when it does?